I want to talk about an account in Canada that is perhaps the best account in terms of tax efficiency, and at the same time, it's underutilized. It's not that popular with Canadians. And that account is called the FHSA, or First Home Savings Account. So why is it the best? Well, it combines the best characteristics of both the RRSP and the TFSA. For example, if you contribute money into the FHSA, you get a tax write-off against your income. Within the account, it compounds tax-free. And then when you take money out of the account, just like a TFSA, it is completely tax-free. So what's the catch? Well, not everyone qualifies. It's designed for first-time home buyers. And you may think, well, that's not me. Obviously, it doesn't apply here. But if you zoom out and think of the entire family, including your children and your grandchildren, and it's likely that you will give them money to help them buy their first home, then this account is a no-brainer. It helps make the entire family more tax efficient. Okay, so let's look at some of the details. Here we have our FHSA, and of course, as mentioned, when you put money into the FHSA or contribute, you get that tax write-off for the funds that you contributed. Up to $8,000. We'll talk about the details shortly. And when you take the money back out, it's completely tax-free, similar to the TFSA. And there's a lifetime limit of $40,000. Compare that to the RSP, where you do also get a tax write-off when you contribute to your RSP, but when you take it out, you are actually taxed on that money. So if you take out $10,000 and you make $100,000 in salary, your tax is if you made $110,000 that year. And of course, it uses RSP contribution room when you contribute to the RSP. So a home buyer's plan is another feature within an RSP where you can borrow money from your own RSP. So you're borrowing your own money, no tax write-off when you take the money out or when you pay that back. But it's less a tax strategy because you're simply borrowing from yourself. And of course, when you repay the loan to yourself, it doesn't count as an RSP contribution. You're simply repaying the loan to yourself. Hope that makes sense. And of course, you must repay the home buyer's plan loan from yourself within 15 years. Now, for the TFSA, you can, of course, contribute, but you don't get a tax write-off when you contribute to your TFSA. However, it grows tax-free and you can take the money out completely tax-free, and it's subject to your TFSA contribution room. Okay, I hope that's helpful. So let's look at some of the details of that home buyer's plan that we talked about earlier. So you can combine the FHSA and the home buyer's plan. And what that may look like is you can borrow up to $60,000 from your RSP. And again, that's just borrowing from yourself. There's no tax strategy here. But you can combine that with funds from your FHSA, which has a $40,000 limit plus growth. And together, that can be a significant increase in your purchasing power. And that's just for one person. You can, of course, combine with a spouse who also has home buyer's plan room and FHSA room. Okay, so what happens if you don't use your FHSA funds to buy a house? Well, it turns out there is a bit of a safety net. The rule is you have to use those funds to buy a home within 15 years of opening the account or by age 71. However, if you decide you're not going to buy a home, you can use your FHSA balance and contribute directly into your RSP without affecting your RSP contribution room. So effectively what that means is you have an extra $40,000 plus growth of contribution room to your RSP, which you would have had before. Makes sense to me. Okay, so quickly, here's some key limits to remember. The annual limit is $8,000 plus any unused contribution room from the year before. You can carry forward that contribution room 1 year. So unlike the TFSA, where your contribution room accumulates year after year after year, with the FHSA, you can only go back 1 year. Now, your lifetime contribution limit is $40,000. That doesn't include growth. You can grow that to $80,000 or whatever that number is. And in terms of the timeline, once you open the account, you have 15 years to use it to purchase a house, or until the end of the year that you turn 71. So how do you qualify for an FHSA? First, you have to be, of course, a resident of Canada and be between the ages of 18 and 71. 18 is actually the age of majority. So in your province, if 19 is the age of majority, then it's between 19 and 71. Hope that makes sense. You also must be a first-time home buyer. Now, here is the government's definition, the CRA's definition of what a first-time home buyer is for the purposes of opening an FHSA. You could pause the video here and have a read, or I'll include the link in the description so you can have a look later. And finally, you, of course, must have a social insurance number. Okay, here's Jimin Hong, who's worked with many families, helping them to open FHSAs and how it's helped them to become more efficient as a family unit.
Just to build on Cameron's point, the First Home Savings Account is a fantastic way for anyone hoping to boost their saving strategy. It lets you invest, watch your money grow, and finally use those funds when you're ready to buy your first home. As a mother myself to young adult children, I really see these accounts being an awesome way to help younger clients learn about savings, investing, and getting ready for that big financial step, like buying their first home. And since there's no gift tax in Canada, it's not just a one-time benefit. Not to sound cliche, but it really is the gift that keeps on giving. Even better, it helps our team here at GM Wealth Management establish and build relationships and connections with our younger clients to support them throughout their own wealth planning journey.
Okay, thanks, Jimin. For more information, you can take a look at this website. This video is not exhaustive, so be sure to check out the website. Here's the link. I know it's a long one. I'll include it in the description, and we're happy to send it to you if you would like. So any questions, don't hesitate to reach out to myself or anyone on the team. I hope that was helpful. And as always, an investment in knowledge pays the best dividends.